Let's bring in our next guest to help us focus on the fundamentals behind the technicals, the rally we've seen in the dollar back above 106. Kurt Nelson's joining us, founding partner and CEO of Summerhaven Investment Management. Kurt, good to have you with us. Good morning. With Powell pushing back on rate cut expectations, no surprise to see the dollar at these elevated levels.
I completely agree. A lot of your viewers are trend followers, and it really doesn't matter what we want the Fed to do right now. I think what we need to do is understand what they're saying and looking at their actual behavior. The Fed is saying we are humbled by our inability to predict where inflation is going to go. We had the sharp rise to 9%, the sharp reduction back to around a 3% range, all unpredictable by the central bank and many Wall Street economists. The Fed now says we're just going to follow the data. So wherever the data comes out, that's what we're doing. So, if you go back 6 months, we were all predicting based on the dot plot, 5 rate cuts this year, starting around March. So we're already a month behind. Now we're down to 2, and some, I think very informed policymakers are saying maybe 0 rate cuts this year. So if you look at the trend over the last 6 months, we've gone from a very confident, early cut, maybe a total of 5 for the year 24. Steadily reducing those expectations. And the reason why is because the data has not been good. It's been good for inflation, but not good for rate cuts. And we've had surprise to the upside over and over again on tight labor, on good economic output in the U.S., in China and elsewhere. And we've seen these inflationary pressures with higher real estate prices, higher contributors to CPI that seem to vary month to month. And, I will say, if you listen to Larry Summers, who has a good lens into this, he was a young economist in the 70s and remembers that this horrible, shock of high inflation got explained away almost every quarter by people in the central bank and economists by saying, oh, it's just, livestock, or it's just lumber, or it's this, we'll take this out and everything's fine. And, at some point, you just sort of have to stop making excuses and say it's inflation. So I think it's been a very interesting 6 months, and that's the reason for the dollar strength.
Yeah, I think there's a few contributing factors, right? One could argue, and as I mentioned, as I brought you in, it's not just Powell, rates, right? I feel like oftentimes you get in these situations with markets where you can kind of throw a dart blindfolded, and in this instance, hit something bullish, right? You've got the euro, Lagarde recently kind of feeding in those expectations that they'll be first come June, ultimately. And I mentioned the Japanese yen as well.
Yeah, absolutely. The yen is trading at a level we haven't seen in 34 years.
Yeah.
So that's pretty extraordinary.
Is that going to spark intervention at some point, do you feel like?
Absolutely. I think there will. They haven't intervened since 22, so it's been a couple of years.
A matter of when, not if.
Yeah, I really think that it's not just the level of the yen, but I think it's the speed at which it's lost traction against the dollar. So it's one thing if you have slow-moving, predictable, trends and changes that policymakers, industry can adapt to. But when you have a large import-export market and you have such a shock to your exchange rate differentials, I think that they almost have to intervene. If no, and maybe not to reverse the trend, but at least to slow it and allow businesses, consumers, et cetera, to react a little more deliberately to this rapid change.
Yeah, I guess that was my next question, right? Would it even reverse the trend, or would it just slow it? Let's talk a little bit about how today we're going to get a 20-year bond auction. I'm curious how much attention should be given towards that, considering some of the uncertainty out there. We'll also hear from Loretta Mester, Cleveland Fed president, as well.
Yeah, I think the thing I'm most interested in is the market reception of the auction, right? Because we still have such a heavy interest bearing load on the U.S. economy. Treasury has to print tons of treasuries just to pay off our, roll our existing debt. And that number keeps getting higher and higher. Of course, it's higher as interest rates go up. So, So I think on one level, the question is, where do these Treasury auctions clear? What rates do we see? But more important to me is the volume and reception. Are we starting to get some cold feet from some of the foreign investors and other traditional Treasury buyers that will suggest perhaps higher rates and more difficult auctions to come? All that's going to feed into this cycle that's kind of uncertain right now, but seems to be pointing towards maybe higher rates rather than lower rates. One of the concerns I have, which is probably it's a bit of a tail risk, but I wonder if not only will we not see rate cuts in 2024, but might the next rate move by the Fed be a rate increase?
Yeah.
And it's all going to be borne by the data. And the trend has not been good for inflation coming down.
Kurt, you were headed in the direction I wanted to go next in many ways, because I'm wondering, is that the 1,000-pound gorilla in the room when you consider some of the pressure rate hikes we're putting on regionals, right? This time last year, ultimately, now that we're kind of moving a little bit further through this pushback on rate cut discussion or expectations discussion, do we start to open up the envelope to rate hike concerns and some fears there? And ultimately, again, where does that leave the regionals?
So, if you think about the pressure that we've had, we had rates close to zero for more than a decade. Very unusual, but we got used to it. And now we've got interest rates at 5%. You look at the last 30 years, there's nothing unusual about that. But it is something that we have not gotten used to. And so we've had pressure. This is if you're funding in a short-term rate environment, your debt load and cost of servicing debt has gone up. During that cycle when the regionals got pressure, we had credit spreads moving out. So it's kind of adding to the pain. Not only are rates higher, but the spreads you're paying are higher. I think I think that there are weaker participants in the U.S. economy that need rates to come down. They're not the majority, but there are some. And the issue, I think, for many of them is not even having rates go higher. It's just rates staying where they are in 25, 26. Having the Treasury around 5%, say 5 year or so, is challenging for them. And a lot of their debt hasn't been, rolled over. They've been okay. So there's a strange effect when interest rates go up right away, which is that if you funded yourself well for the next, say, 24 months, strangely, what happens is you're not having to go out and raise more debt at the higher interest rate. And in your surplus cash you have in your balance sheet, you're now earning a much more positive yield. So perversely, it actually improves your financial condition in the short term. But if rates stay higher for longer, at some point you have to service that debt at a higher rate, and it starts to really inflict pain. I think we're reaching that point, Ben, where there's a desire for rates to come down, but I don't know that they will. I think the Fed they've got a pretty iron will. They will do what they have to do. They're probably one of the most independent branches of our government. And if the data shows that they have to not only not cut, but perhaps start to tick higher in Fed funds, I think that they will. And that will be a real shock in 25.
Sounds like in terms of the banks, there's always a couple bad apples, right? But it's a matter of how long they sit around the others before they start to spread, and that spoiling starts to become a little bit more contagious if they can kind of get rid of them immediately or cap it ultimately. But in terms of the Fed, right, obviously credibility coming into question here, and definitely some pressures on them as we continue to focus on the data. Kurt, always appreciate you joining us. Kurt Nelson joining us, founding partner and CEO of Summerhaven Investment Management.